kindle worries for an impending recession. On the other hand, persistent optimism for an increased consumption levels from China seems to provide a floor on the crude prices. Despite surging COVID cases and grim growth outlooks, another large unexpected buildup in crude inventories may have put some more pressure on WTI, and today, energy traders await for an update from EIA stocks. In this report, we aim to shed light on the catalyst driving WTI's prices, assess the future outlook, and conclude with a technical analysis. Crude oil paired early gains during yesterday's session after weak economic data in regards to consumer spending and industrial production, but also due to repeated hawkish remarks by Fed policymakers. Even though retail sales for the month of December contracted more than expected, proving in a way that the Fed's tightening efforts are indeed demand destructive. They also increase the probability of US entering a recessionary period. Furthermore, also worrying was the further deterioration of the industrial production rate for the month of December, reporting its second month in a row in the negatives and simultaneously the largest drop since September 2021, practically intensified fears of a slowdown in the world's largest economy. Adding more salt to injury were the hawkish comments of St. Louis Fed President Bullard, who continues to reiterate the need for more rate increases, stressed the need for raising the terminal rate north of 5% in order to bring inflation down, closer to the central bank's 2% target. He later added, "We're almost into a zone that we could restrictively, we're not quite there yet, and that the bank should not stall before getting to the end zone." Cleveland Fed President Masters' speech shared similar characteristics, leaning towards the hawkish side, but refrained from disclosing the magnitude of further hikes. Overall, the intensification of worries for a possible recession and stark comments for more aggressive monetary policy tightening kept energy bulls at bay, pushing them to reconsider their short-term outlooks. The FOMC policymakers will convene on the 1st of February, and currently the Fed's Fed future showcase a 92% probability for a 25 basis point rate hike scenario to materialize. Yesterday, the API crude oil inventories marked the third consecutive week of large buildups, as the agency reported another unexpected pileup of 7.6 million barrels, exceeding expectations. The EIA weekly crude oil inventories report is pending and is expected to hit the market later today. According to estimates, the figure is estimated to report a drawdown of minus 0.5 million barrels, yet analysts caution that the result may present an upside surprise, mirroring yesterday's API results. Last week, EIA reported its third largest buildup of crude stocks ever, yet we noted that the effect of the report was dampened by the overwhelming optimistic outlooks for China's reopening, which fueled further WTI's ascent last week. Should the data indicate another large buildup in crude oil inventories later today, we may see WTI relent some ground and fall lower. Thank you for watching.